All right, everyone. So thanks once again for joining. It's been, I think, very interesting times in the market. We have been discussing every week here, and today's goal is to look at what is changing because a lot of macro parameters are changing very fast. We had a question right before this. We started recording about the yields, and I think that's what everybody's watching right now. So we are going to discuss a little bit looking at the charts and so on. But basically, what is happening right now, and what we are most excited about is the public markets are holding up, like the stock markets are holding up very well. While of course we all know that the economy is cooling down, we are seeing the employment number coming lower and lower. Even as we talked previously when the last employment numbers came, that there is always an adjustment down also for the previous numbers, which is not a great sign ever. So overall, we have always discussed that the 4.25% rate is still highly restrictive, still very high. And that is what I think is changing now with the market expectation moving to rate cuts. We have been discussing this in WhatsApp. We are going to start looking into some of these ideas. So I think let's get sharing like usual, and we will look at the charts first so that we can also try to interpret this in the bigger picture. So I always start with a zoomed out view. As you know, the goal here is to look at where we are, not because it's very easy to get lost in day-to-day noise that market fell today or market went up other day. But in general, if you look at this, we are sitting on a huge rally. We are talking about, what are the key things which happened, which changed the market direction. And I think we have talked enough about it. So let's focus on in last few days. So we are still sitting right at a new high, which we actually made just today. Means today's high was, if I understand correctly, was the new high, all-time high. So we are basically, of course, we corrected later in the day from there, but it doesn't mean that market is, not in a all-time high situation. While the tech stocks, which we have been tracking since last week, and I had talked about this last week also, they made their high in middle of August, and we are yet to reclaim that high. Even though today we tried, I think Avago earnings was one factor which started the market very well. Also, another factor which we are going to discuss and as I've been talking about is the rates, like the yields are dropping like anything. And that was another factor where market started very well today, because what happened is today we got the new jobs numbers and they looked pretty bad. And that's what I think market got triggered by. And as we all will know that even though it's a negative news and we are still in this high rate scenario where rates are at 4.25%, everybody's anticipating rate cuts, and all bad news means that we have a higher and higher probability of rate cuts, and not just one rate cut, but now market is pricing 3 rate cuts in next three Fed meetings. And that is what is pulling down all the rates, because one thing is it's very clear that the economy is cooling when the job openings are reducing so fast. And secondly, I think it's already confirmed, as we discussed in the after the Jackson Hole pivot, where Powell already mentioned that unemployment warrants pivot. And second thing, which we talked about that week, how the 2% hard limit has been made fuzzy now in official language. So overall, what we are trying to highlight here is market is, because it's a tech-driven, wider economy was anyway not doing good, which is already priced in. So it is great news for asset prices to go up, because now we are talking about cheaper capital. We are talking about how the market is going to be much more easy money coming into the mix. So now let's go back to the rates. Now, it's very interesting that just a couple of days back we had a totally different situation, and let's look at the panic which was created by the 30-year hitting 5%, and similarly the 20% was going up. So 20 years was going up. So what I'm trying to highlight here is, if you see today, the situation has shifted so fast because, as we have been talking about, most of the long term is irrelevant, because that is mostly term premium. Most of the financial instruments look at 10-year, and 10-year was going downwards, which we have been talking week over week every time I have been showing this chart. And a very simple way to demonstrate was where I created this 3 slope, that every high, when you match the lower high which is being made, is being further and further slope going down. And now we are almost crashing from there. So basically what we are seeing here is that the 10-year is just falling off the cliff. And the reason being, as we just saw, the macro is shifting very fast. We are seeing the jobs number coming down. And I think the another question was what is happening with the shorter term, and what shorter term is, why shorter term is crashing even faster is because now market is expecting even faster rate cut cycle. So we are in this whole reducing cost of capital environment where we are saying that we kept the rates too high for too long. Very similar narrative to what it was last year. At some point, I think around similar September, October timeframe, we had very similar narrative, and that's why they started with a 50 basis point cut. And now I think we are hitting the same area where we are saying after the pause, the market is now questioning Powell and the Fed of why the rates were not cut earlier. So overall, basically what we are saying here is that the rate cut now, my market is pricing, if you look at 1 year, it's going to be even going down even faster, because the idea here is that we are expecting rate cuts, not just one or two or three, maybe more than that. So that's where I think we are hitting right now. And I'm going to go back to the 10-year, which is ultimately the benchmark, as I said. So anybody who 2 days back who was questioning, and we did discuss this in WhatsApp also, of why there is a panic being created for 20-year or 30-year going up, that is just a market reaction to liquidity probably. There can be many factors, but ultimately I would recommend to just watch 10-year yield. And that's what matters, and that's dropping right now because the economy is cooling very fast. On the other hand, now let's focus on what is this bull market. Well, now you can ask, it's contradictory that stocks are at all-time high while the interest rates are falling as if we are heading into recession. But again, I keep talking about, let's look at IWM, which is the Russell 2000. Um, it is not moving at all. Like this, if you look at the highs of 2021, highs of 2024, means it's basically, while SPX or all kind of, NASDAQ has been making new highs. We are, if you look at multi-year wider index, it is, and by the way, these index also include tech stocks and other which have benefit from AI. So even as a whole, other wider companies are basically pulling everything down. And now, since we are seeing higher chances of rate cut, these are going to revive. So you're going to see rotation into these smaller caps. You're going to see people getting optimistic that they can also revive, while the lower cost of capital also means that spending is justified by tech players. As the rate cut cycle starts, there is a more and more capital available because they are looking for yield. They are looking for, because the people are going to move into how do you invest this capital to generate higher yield if the yields start going down. So this is what, and also justification for investing into stocks is going to be higher now. And this is an AI cycle. This is not a better economy cycle. In most of the SPX gains have been due to AI because of NVIDIA's of the world and Apple of the world, and Microsoft and so on. And within that, we also talked about rotation. We talked about how first NVIDIA made highs. We saw how Apple was lagging. Now Apple is catching up. We saw Amazon catching up. We saw Google catching up. You will see more and more new highs being made, rotation being done. Like first we saw Meta and NVIDIA running, or something like Microsoft running. So this is, even within the tech sector, there is a lot of room with the rotation. And I think the key, again, I would say to watch out for is if Nasdaq starts breaking out again, because it is yet to make a new high in last few days, even though SPX has been hitting new highs. So I think this is where the opportunity is, with the rate cuts coming, with the tech sector going through rotation and consolidation. We do have opportunity here that the market can keep making new highs. And going back to what are the leading indicators? We talked about it for many months. We had been showing you this consolidation of gold. Now, when the money supply is good and when the yields are dropping, people are chasing investment opportunities, and the gold is the first one to break out. This is another indicator that now we are going to look for some of these assets, which we call them, whether you can call them risk asset or you can call them hedging against low yields. That is, I think, where we have the biggest considerations. All right, so that is it. I would say I wanted to cover. We can take a few questions. I see a question in the chat which says, would the rotation into small caps hurt big stocks or the tech stocks? I would say, in a way, you can say it's already probably hurting, because what we're talking about here is that we have kind of flattened out, if you see on NASDAQ. And I think this is where we have this situation where we are saying that how can you, why is SPX going up and NASDAQ not making new highs? That means there is some rotation happening. and tech stocks are taking a breather. So I would say there is already some impact. But if you look at the market cap and the money in the market or whatever, it's a paper money, but it's still money invested in the market. The rotation, you don't need much money to lift the small cap, while this large cap are very big. So the thing is, it's about the size of the each market, and we are seeing that it's very difficult to impact Mag 7 because we're talking about trillions of dollars of economy or the market cap versus much smaller players. So I don't think that has ever hurt the market. And also, as we said, right, means we just now I was looking through the summaries from some of these. I think all the tech CEOs were in with Trump, and there was a press conference going on, and they're talking about. I think Trump asked Zuckerberg to answer a question, and he said, "Well, we are planning a $600 billion investments in data centers in next 3-4 years." So this is the level of confidence tech has right now in AI. This is the level of spending which is going on. So market is, I would say, the amount of money which is coming from bonds at some point, which will start rotating when you see the yields going down, that will cover for more than enough into tech. So I think right now the biggest question is what will be the impact on inflation? Are there other blocking factors? Because I would say the biggest risk right now is not about for the tech sector is not about whether small cap rotation will happen. The biggest risk is if this yields dropping creates easy capital and banks with the recent policy changes on SLR relaxation. When do we start seeing the overheating of economy again? When do we start seeing inflation again? And that is, I would say, the biggest risk. But in short term, all these factors take a long time to take impact. The whole heating up of the economy takes 3 to 6 months at least after the banks start issuing loans and money becomes easier and cheaper. So I would say in short term, market is very optimistic on where we can head, and I don't think rotation would kill that. So that would be again, nobody has seen the future because as we know, right, these markets are paper money. There's a lot of money rotation happen all the time, and there can be leverage which can be killed any day. One big bad news, one geopolitical event, one Trump comment. Of course, all those risks are still there. I'm just saying macro perspective, the risks are limited to probably inflation now. And we are assuming that the Fed cuts are almost priced in now. So there is no reason that Fed will not cut rates now. And that is where I think market is going up because of that. And also, as we saw in the earnings also, right, we went through the earnings cycle. There is no slowdown. When the capital is becoming cheaper, we don't see why the capex will start going down. We saw with the Avago earnings last night when they talked about they are getting new orders. So on one hand, people are worried about Nvidia or other people slowing down. On the another side, we are talking about a totally, Avago saying that we are still getting a custom chip development orders. What that means is the AI investment is not slowing. People are even willing to pay, money to develop custom chips. That means even the whole AI sector has a huge run up ahead. And if you take out AI, anyway, tech was not doing good overall. So I would say AI spending is the only thing you have to watch out for, and that is looking good. And that is where I think tech is finding confidence in. All right, so this is all I had in terms of market. So please feel free to add questions. We have a few other things to discuss today. I will wait for a minute or so to let you ask questions. You can unmute yourself or you can post it in chat. All right, so I think if there are no other questions, so there are a couple of quick announcements. First of all, before we jump into the second part, which I wanted to discuss is one is that for the all access subscribers, we have started a WhatsApp exclusive channel because we usually had Discord for the members, for the paid subscribers, where we are able to discuss. The reason being that in the macro WhatsApp, it's an open channel and we cannot discuss specific trade stuff. So this was a feedback for a long time. So we are starting that. So my team has told me that the messages must have gone out. So you should go and join that, and we will start approving people. The goal there is to make it more communication with the subscribers and get more feedback and maybe even generate more discussions around what we do in all access. As I mentioned that all access is purely educational service, so that is one disclaimer I would like to add also. Even though we give you a model portfolio, trade advice, and so on, but that is a DIY where you build your own portfolios and you do it. So just as a background. Also, I wanted to talk about how we are doing pretty good in managed portfolios in terms of what is, we have shared the returns and we have been growing very fast right now. And we have some of these new things coming up. We are also taking up some institutional clients. We have been building products with them for some time. As you know, my background working with hedge funds, working with some of these institutions. And as I was telling before the call recording started, that how the depth of the options market is growing in last 4 or 5 years, and there is a lot more exciting opportunities opening up in this space. And while working with the institutions, we are also realizing that these are the things which are opening up doors to new ways of investing. And I'm going to touch base a little bit on that in a few minutes. In the meantime, let me quickly take a question on BTC. So I do see it in chat. So basically, Bitcoin, I would say there's nothing new in terms of what we discussed from last week. So I did not have any specific comments to make because it's in a very similar zone of consolidation. It did take support as maybe I can share the chart quickly so that we can definitely talk about that, which we missed today. Yeah, so I think Bitcoin, we did discuss last week. It was in this, as you know, that we broke out from the flag. And we have been tracking this flag from, in terms of technicals, that it was taking support on the same breakout line. So what we are seeing here is that while it took support, it has also broken out from the downtrend. If you take the trend lines, so in general, it's positive in the sense that it has been stable. On the other hand, it is not yet convincing because as we were tracking the previous high, which was 112K, was the critical point which it broke down from. So overall, rotation into Ethereum, rotation into Solana, and all those treasury companies has hurt Bitcoin. On the other hand, it is again back to uptrending line. So that's all I can say right now. It's in a consolidation pattern. No confirmation on either side. We have to watch 108K on the downside and 112 or 13K to maintain this uptrend. So it's indecisive, I would say, and that's what is happening. But if you look at the macro, we have already discussed from a market perspective, the same reasons apply because as the yields drop, you will see, and also gold is a great proxy for it because ultimately the narrative for Bitcoin is also the same, which is a digital gold. So I would say gold has been the leader. Means if you see after the gold breakout last time, Bitcoin did very well, and then while gold was consolidating, Bitcoin was making new highs. On the other hand, you see that very similar rotation which is happening here. And also, if you go back to a couple of weeks older recording, you will see all the details about we discussed about how the Ethereum has gained attention, and some of these altcoin rotation is also hurting Bitcoin right now. So that is my take on what is happening with Bitcoin. But I think from a macro perspective, it's kind of similar that Bitcoin is one of the risk assets in the modern world. Some people call it as a digital gold. Some people use it as a hedge against inflation. But overall, it is kind of tied to the money supply, and which is going up, and the cost of the capital, which is coming down. All right. So the other thing I wanted to discuss, if there are no other questions, so we have a new product which is launching from Proflex, and we are calling it DualEdge. So the thesis is, as I said, right, means Proflex has been working on using options, using our hedged strategies. We have been, as if you're a member of All Access, you have already seen how we are always looking for a strategy where we have a plan. If it goes bad, we take pride in taking trades to success rather than chasing the highest possible return per trade. We do hedge, we do when the market goes too hot or something. And also we have always done downside protection. And if you are part of managed portfolios, most of our trades are hedged because we don't believe in, of course, you always play the macro game. You always pick up the asset classes which you believe in using the research, but you also want to make sure that you are using the time premiums of the and so on. So that has been our thesis, which we have been working on for 2 decades. And within these products, you have already seen if you are part of any of these products. This has led to many other things because we also work with institutions and we have been helping them and advising them in some other products which were basically generating yield on single assets. Like if they hold a lot of stock, if they want to invest for for a long time in a certain stock and they want to generate yield, we have been doing that. And I think this has been going very well. So we have decided to launch this as a product. Again, we will have a more detailed call on Sunday for that, and I think one of our team members will post it in the WhatsApp group if you want to join. One disclaimer is it's for accredited investors only, because it's not like managed portfolio or all access. It's not it's a private fund which is going to have only accredited investors. But let me give you a bit brief of what it means, right? Our goal is to offer an option where people are, means we have seen there is a big demand. Why are we launching for retail? Because we do see that a lot of people either invest in fixed income, for example, like you have a CD for generating 4%, 5% returns, which have been possible in the last few years. And before that, people have invested in some high yield product, like you invest in real estate or something for income. And then you have a choice to make in growth, where you're saying, I'm investing in S&P 500, or I'm investing in NVIDIA's or Tesla's of the world. And there is a choice to be made. But what we have done with the institutions is that where we say we can hold an asset and we can also generate income on top of it. And using that, we are opening up this, we call it DualEdge. The goal here is that you generate fixed income on a regular basis, and you are also invested in a risk asset for growing as a long-term wealth generation. And that's a product which is a mix of the two. And the goal here is to generate high yields, means because the opportunity, as I was mentioning, is huge in this space. And that's what we have been demonstrating in Proflex by generating high yields on either all access product or your managed portfolios by generating yield on top of an asset. And that optionality is what we are excited about, because once we did this with institutions, we realized that retail investors need this, where you are always choosing between this much capital for fixed income and this much for growth. And we are basically making it as a income product which can give you long-term exposure to growth also. And that is, I think, the crux of it. As I said, we will send you the invite for the intro call with more details. It is going to be a closed group because of the regulatory reasons. It's not an open product because it's a private fund with accredited investors only. And I can take a few questions as the goals of it if you want to have, but I think it would be appropriate to go into details only in that private call. So just a couple more points around that is the idea there is to generate high yield with an option to convert it into equity exposure after a few years, and also a hedged structure so that we take minimum risks on the growth capital. So that's the product, and the goal is for people who are looking for income. Another use case I would say is that while we are working with managed portfolios in Bay Area, as I talk about, like I talk to so many clients who have most of their assets tied to a single stock, not because they invested in it, but sometimes because they have RSUs from their companies, or they have stock from their previous companies, which has grown too much, and they are not able to sell it. And this product will be very interesting for them also, because the best part about this is that you don't have to sell your existing stock and you can generate income on it by bringing into this structure, which is basically not generating a tax event because of the in-kind contribution rules which are available in IRS. So this is another reason why I would say we are excited about this product. And as we are scaling up with with institutional product, with the managed portfolio into, as I was talking about, into 8 figures, we are very excited about the liquidity in the market. We are very excited about the options market, which is growing in US in the last 4 or 5 years. You may have already seen many such products in ETF world. Why are you seeing so many ETFs growing? We can talk about that, right? Means because the world is changing very fast in public markets in US, and no other world markets are as liquid in derivatives and options as US. If you're reading any other news, I know that most of us are Indians, and we are reading this kind of a fake news that Indian market, option market, is biggest. But if you go and trade that is because there are a lot of people making 10 rupee trade, 10 rupee, 20 rupee trade. In reality, the depth of US dollar options market and the size of the market is so huge, and it was not there 5 years ago, let me tell you that. And we are observing it firsthand. We are basically, as we are building more bigger and bigger products as we go into 8-figure numbers and so on. So what I'm trying to highlight to this is that this is not something which existed 5 years ago or 10 years ago for sure. Definitely not as liquid 5 years ago. And you're going to see these opportunities, and our goal is to educate you. Even if you don't want to come into this product, I would like you to come in and learn at least of how the financial markets are changing in US, and how can you benefit from it by just learning more and being at the cutting edge of it. We did this previously. Means I enjoy this because we did this with the coming into crypto early. We did this with coming into this treasury companies. We did it with coming into AI trade early. Even something like Tesla, which was difficult to justify in old days. Even in Facebook in 2015. So I take pride in just spending more time deep diving into opportunities in the financial markets and coming in early, because there's a huge difference between coming into the yields which are available at 10% today will probably go down to 5%, because we know that even the risk-free rate is coming down very fast from 5% to 4% to probably going to be 2% in 2 years from now, if the rate cuts materialize the way people are thinking. So everybody should think about what is your fixed income plan, because this 5% rate is already gone and 4% will be gone very soon. So this is another reason why I've asked people to consider that, because fixed income is always a big part of your portfolio, even if you are doing growth investment. And this is where I think we are excited about this product. So we will discuss more on Sunday. So I don't know if the team has already sent that invite, but you should see the Zoom call invite there. And if you register, we will send you the recording if you're not able to make it. So feel free to register there. Anyway, so these were the announcements. So as I said, the quick summary: we have this DualEdge launching. We have, if you're all access member, do get into the WhatsApp group. In general, I would say we did talk about markets, but I think I'm ready to take a few questions now on all these topics, including the markets and so on. So do let me know. All right. And one other announcement while we're waiting for questions is we are planning a Proflex Investor Day. If you joined some of those previously, you know that our goal is to create a networking event for all of our subscribers and for our now the clients in managed portfolios and so on. But also talk about what is the latest going on in the markets, and how to filter the noise, how to generate, like we do a little more deep dives into the macro. We do a little more we did an options workshop last time, which was very successful, and a lot of people learned new things. This time we are doing very similar thing, which is planned in the first half of October. The exact dates are being worked out. Usually it's on a weekend, so you can assume the first 2 weekends as the target dates. You will see that, so watch out for that and do register. And our goal is that to create that as a meeting place for smart investors. Our goal is for you, not only you to figure out if you want to join, but also invite your friends, invite your, means we are spending a lot of time here. Means I personally spend a lot of time here in this call and in preparing for those kind of investor days. When we subscribe as we do in All Access, which is more of a paid place. I think these events and this call is also uses a lot of our research, a lot of things which we do. So yeah, it would be very useful, especially for people who are here on this call and who are very regular with us, to spread the word, because it's not just about bringing people in. It's also about more questions asked, more diverse question asked. People who question us is also a value for our community. So it's not just about I want to talk to more people. It's also I want to listen to more people. So that is where I think we can add value as a community. How we grow wider voices and learn together from each other. That's a goal into this event. So not only for this call, I would say for the Investor Day, do look out for the dates, and I'm relying on all of you to help us grow this Proflex community for even better learning together. Because remember one thing, that if you're learning from sources which are which everybody's watching, like CNBC or newspaper or your Twitter, even Twitter, basically that is just kind of echo chamber of the common popular beliefs. And if you are an investor, you've already missed the bus if you are following that. And our goal in Proflex has been to capture the trends early, filter the noise, and see the signals ahead of time. So that is, I think, and I don't want to be in a situation where our community is not growing anymore and we are still listening to the same. We do not want to create our own echo chamber. So when we are growing, we are also learning new things. So that's my way of thinking. So please feel free to share the WhatsApp group with your friends if you're finding value. And if you're coming to the event, please bring a friend. That is always our message. I do see a couple of questions on the chat. Let me go to them now. So there is a question on CRM and software sector in general. I think this is a good way to ask. Like, I think a lot of people are talking about how AI is going to eat into SaaS, and all these software as a service companies had been hurt, I would say, in valuations. We did see some of them going down, and also I think there is some impact to earnings. Like, I think CRM was one of them, which people were not excited about their earnings. But on the other hand, I'm hearing another view where people are saying that in the industry, the penetration of AI, where people are taking off their existing tools and going to AI, is very, very slow. So I think we are still at the early days of AI. So means I don't have the crystal ball to say what will happen 3 years down the line, but I would say nobody's losing their revenues today. Yes, there are some growth concerns, which might be also because of, as we talked about, wider economies, right? We are talking about, it's very difficult to define whether it's an AI impact or whether it is general slowdown impact. When we are seeing jobs numbers being low, when we are seeing wider economy not working fine, so somebody like CRM can be hurt because of that also. Now the question is whether they are able to utilize AI is going to differentiate the software sector. Like, if anybody who is going to use AI as a tool and grow their business, and that's what investors are asking, and that is what you will see in every investor call, every earning call. People are going to debate for, and when the paradigm shift like AI happened, like when people moved from software which was in a disk drive to a cloud-based software, a lot of new companies disrupted the existing businesses. Some of them did very well. Some of them, like Microsoft and somebody like Intuit, you can take an example. They did very well moving from the old paradigm to the cloud-based models. So my take is same, right? For all of these companies have an investor base. They are very strong. They have a customer base, I mean, and they know their customers best. So the first bet is always on them to be successful when the paradigm shift happen. So that is going to be my take on it. But yes, some companies who are not able to catch up with AI will lose out, and the time will tell which ones survive, which one don't. And this is why I think if you are an investor into individual stocks, you have to go and continuously review how their progress is in their AI deployment. Go listen to earning calls, try to figure out if they are making any progress because of AI or they are losing out to their clients. So that's the only way we can individually figure out. But my take is that in 2 years or 3 years from now, probably half of the software sector companies will struggle and half of them will actually do even better. And whether CRM is one of them or specific other companies are one of them is too early to tell. And definitely we can, and again, as I said, my goal is not to take up one specific stock here in this call, but the companies we are tracking, we are mostly focusing on how they're benefiting from AI and how they are losing out to AI. And that's the best way to learn about them. I see another comment here is about the Zoom screen on Investor Day. So I think we try to do for remote, especially people who are outside. But as you know that I always say that our goal is to create a event where people are talking to each other and learning together. Half of the part of the event it's very difficult to cover on Zoom. Sometimes we do whiteboarding and so on, which doesn't go into Zoom. So definitely, I think we have always tried to make Zoom available, but it's coordinating live audience and Zoom audience is very difficult. And that's where we try to prioritize the local, because we always do Zooms every week here. My goal is to prioritize the local audience in the room. But yeah, that's a feedback which we always get, and we always try to enable Zoom. So no doubt about it. So thanks for the feedback. But yes, our intention is to make it as widely available as possible. Also, as you know, that we have been, our audience is usually, our community is growing also. So every time we do the event, usually we look for a new space which is bigger. And when that happens, we have some uncertainty around the technology also, like whether, so I don't promise usually at a new place how the Zoom will go. So that's usually we'll learn on the day. We had our own share of bad situations on Zoom in the previous events. But again, I think great discussions today. I think on the when we started with the yield, we started with all this. So nothing more from my side. As I said, if you're interested in this new product, we are going to be sharing more details on Sunday. So do join that Zoom call. And let's continue, I think, talking in WhatsApp. Our goal is to create this space where we can have intelligent conversations. So bring your friends, share topics. I think if I would recommend people to talk more there, and don't worry about, if you have a question which is, which some people may not like, because half the things I say people don't like. I mean, I welcome all criticism, because that's how we learn. If we say things which is not common knowledge, because if you are just repeating what CNBC is repeating, that is not learning. And just question everything, bring your friends, have a conversation about topics which make you a better investor. That's a goal, and let's keep doing that. So again, if there are no other questions, I think let's give everybody their time back and enjoy your weekend. Have a good Friday. Thanks, everyone.